Welcome to our in-depth exploration of litigation finance, an unconventional asset class that's rapidly gaining prominence in the global financial landscape. In this video, we'll peel back the layers to understand what litigation finance is, why it's attracting significant investor interest, and its potential to diversify investment portfolios. From its origins in common law jurisdictions like Australia and the UK, litigation finance has evolved into a global phenomenon, reshaping how legal disputes are funded. At its core, litigation finance involves third-party investors providing capital to litigants or law firms to cover legal expenses in exchange for a share of the potential recovery. Unlike traditional lending, this isn't a loan. It's a non-recourse investment, meaning if the case loses, the investor loses their capital and receives no return. This non-recourse nature is a key differentiator, shifting the financial risk from the claimant to the funder and aligning incentives for successful outcomes. Return structures typically involve a multiple on the invested capital or a percentage of the final recovery, ensuring funders benefit directly from successful litigation. So why is litigation finance increasingly viewed as an attractive asset class, especially by institutional investors? One of its most compelling features is its non-correlated nature. Litigation outcomes are driven by legal merits and judicial processes, not by the performance of the stock market, bond yields, or commodity prices. This independence means litigation finance can provide diversification and stability to a portfolio, performing well even during economic downturns when traditional assets struggle. Its performance is case-driven, rather than cycle-driven, offering resilience when other investments falter. Furthermore, litigation finance offers the potential for high absolute returns, often significantly exceeding those found in traditional asset classes, alongside the benefit of risk-sharing with claimants. By assuming the financial burden of litigation, funders reduce the claimant's upfront costs and risks, enabling access to justice for meritorious cases that might otherwise not proceed. Now let's delve into the mechanics. How does litigation finance actually work? The process typically begins with case origination, where potential cases are identified through law firms, direct claimant approaches, or specialized intermediaries. Funders then engage in a rigorous due diligence process, meticulously evaluating the legal merits, potential damages, enforceability of judgments, and jurisdictional considerations. This can involve extensive legal analysis, engaging external counsel, and expert witnesses to assess the strength and viability of a case, ensuring only high-quality claims receive funding. Once approved, funding mechanisms are established. Crucially, litigation funders do not control the legal strategy or decisions of the case. That remains with the claimant and their legal team. This non-interference principle is vital for maintaining ethical boundaries and avoiding conflicts of interest. Funders aim for a diversified portfolio of cases to mitigate the inherent binary risk of litigation. The litigation finance market has undergone a remarkable evolution over the past decade, transforming from a niche offering to a recognized component of the alternative asset landscape. We're seeing growing institutional adoption from private equity, hedge funds, and pension funds, alongside an expansion into new areas like defense-side funding and arbitration finance. Analysts project the market to reach an impressive $17 to $26 billion by 2025, underscoring its rapid growth trajectory. Increased awareness among corporates and law firms, coupled with the emergence of secondary markets for litigation finance assets, signals a maturing industry. The scope continues to expand beyond single commercial disputes, encompassing intellectual property, antitrust claims, and sophisticated portfolio funding arrangements. Growth in collective redress and class action financing, alongside rising demand for cross-border litigation and arbitration funding, further fuels this expansion. Leading the charge are major players like Burford Capital, Omni Bridgeway, and GLS Capital, among many other specialized firms, driving innovation and setting industry standards. However, like any evolving industry, litigation finance faces its share of ethical and regulatory challenges. Historically, doctrines like champerty, which prohibit third-party interference in litigation, posed legal hurdles. While largely relaxed, these historical perspectives still influence ongoing debates. Debates around transparency, particularly regarding funding agreements, and potential conflicts of interest between funders, lawyers, and claimants, remain central to regulatory discussions. Let's consider the inherent risks and the significant rewards associated with litigation finance. The primary risk is binary. Either the case succeeds and yields a return, or it loses, resulting in a complete loss of invested capital. Litigation also entails long time horizons, often years before a resolution. Despite these risks, the potential for high, non-correlated returns and portfolio diversification makes it an attractive proposition for sophisticated investors seeking alternatives to traditional markets. Looking ahead, litigation finance is poised for continued growth, driven by increasing standardization, greater market acceptance, and expansion into new jurisdictions globally. This unconventional asset class is undoubtedly on the rise, reshaping the future of legal funding and investment.